We're taking a look at bonds and gold. John, are there bubbles here?
Well, there's certainly been a very big participation in gold from an investor standpoint, with from anywhere from physical to exchange-traded fund to futures. Gold has been an attraction for investors to fight against deflation as well as inflation, as well as instability in monetary standards. And with the situation that's been going on in Europe with their debt crisis, here in America with our spending spree from our QE2, gold is also, from a global perspective, from China and central banks starting to stockpile. I think there's still a longer-term bull market cycle and still upside potential in gold. However, Karen,
it's always a but.
There's always a but. I want to warn your clients and investors out there that traditionally we do see pullbacks in the gold market. I would be looking, and gold has had a tendency to be very violent when it tends to see corrections. Some corrections can be up to 10 to 15%. In 2008, from on or about October 10th to about the 20th, we saw approximately a $250 correction in the price of gold from peak to trough. So even though gold has moved substantially higher since then, it's just a matter of where you get in that can scare an investor out. Traditionally, on or about the middle of December, about the 14th of December, believe it or not, gold traditionally kind of bottoms out, gets through its rust patch, and then we see rallies going into mid-February. So if an investor wants to get into the gold market from that short-term time period, we're talking maybe 4 months or so, I would look for pullbacks, and if I was going to trade from any side in the gold market, it would be the long side on a pullback in mid-December.
How about the bonds? For the first time ever, people were willing to receive a negative yield for the government to hold their money. And with people pouring money out of into bond funds, out of stock funds, what's your feeling there?
Yeah, the bond market's been very interesting. I do a lot of work with seasonal tendencies, and the interesting thing is bonds, and they did it again this year. Bond prices traditionally peak in November and trough sometime around April. This year we saw the move started to happen a little bit earlier, and more importantly, people thought with the Fed buying bonds, and once they heard the amount, that's when they actually pulled the rug under from the price. We saw the collapse in bond prices.
That was counterintuitive for some reason.
A little counterintuitive, but it was about time. A lot of people have been calling for a top in the bond market, and I think, there's an old phrase that we had at the Chicago Board of Trade prior to the CME's purchase, was bond boys know best. Bonds are dictated by interest rates. Interest rates make the money go around by money. So money in that field, if you want to know where the smart money is, watch what the yield curve is doing and look at bond prices. Right now, I think what the market is telling us that down the road, people are not interested in buying 30-year or long-term bonds. And so we're starting to see the yield curve starting to steepen. And that's a good sign, actually. And I think that might bode well and confirm that we are seeing money come out of bond funds and into equities. So if that's the case, then perhaps our economy is on a stronger footing than what most people believe. So, of course, time will tell. But at this point, I would look for rallies to be selling bonds. And I believe that if there's a chance you see the March 30-year bond futures hit back close to 130, I would be looking to be a seller.
Thank you, John.
Thank you, Karen.